Welcome to StockTok's deep dive into Truist Financial Corp. Truist is one of the largest commercial banks in the United States, providing retail and corporate banking, insurance, and wealth management services across a broad geographic footprint. At the time of recording, the stock is trading at 50.57, sitting comfortably above both its 50-day moving average of 48.61 and its 200-day moving average of 46.28. A structurally constructive setup that suggests medium-term momentum has shifted in favor of the bulls. The 52-week range runs from 35 on the low end to 56.2 at the high, placing the current price in the upper half of that band. The 14-day RSI, a measure of near-term momentum, reads 65.5, which we characterize as neutral trending toward mild strength, not yet in overbought territory. Let's work through the fundamentals, scene by scene, starting with a quick business overview. Truist Financial Corp is a Charlotte-based bank holding company formed from the merger of BB&T and Sun Trust Banks, giving it a diversified revenue base spanning net interest income from lending, fee-based wealth management, and one of the largest insurance brokerage operations among U.S. regional banks, a meaningful differentiator in the peer group. The StockTok score for Truist sits at 39 out of 100, a caution rating. Breaking that down across 5 dimensions: valuation scores 14 out of 20, financial health scores 7 out of 20, profitability scores 10 out of 20, growth scores 0 out of 20, and smart money scores 8 out of 20. The composite GF score, a separate quality gauge, comes in at 69 out of 100. The headline message is clear. This is a name that warrants careful scrutiny before conviction. Now, valuation. The question every investor has to answer: are you paying the right price? Truist Financial Corp carries a trailing price-to-earnings ratio of 13.27 times, meaning investors are paying roughly $13 for every dollar of trailing earnings. That is modest by most standards. The forward price-to-earnings ratio drops further to 11.32 times, which suggests the market is pricing in earnings improvement in the near term, a mildly encouraging signal. The price-to-sales ratio stands at 3.24 times. The PEG ratio, which adjusts the price-to-earnings multiple for expected growth, and the EV-to-EBITDA ratio, which measures enterprise value relative to operating cash generation, are both effectively unavailable in a meaningful form here. As is common with bank holding companies, whose balance sheet structures make traditional enterprise value metrics less directly applicable. On economic moat, in our view, Truist's competitive advantage rests primarily on scale, a deeply embedded retail deposit franchise, and its differentiated insurance business. Switching costs in commercial banking relationships tend to be high, which provides some pricing stability, though the moat is not as wide as money center peers. The Guru Focus Value, an intrinsic value estimate based on historical multiples and growth, stands at 46.71 at the time of recording versus the current price of 50.57. That implies a margin of safety of negative 8.26%. Meaning the stock is trading at a modest premium to that intrinsic estimate. 19 Wall Street analysts at the time of recording have a consensus mean price target of 55, with a high of 63 and a low of 45, and the street consensus recommendation is buy. The next earnings report is due July 17th of 2026, with the street expecting earnings per share of approximately 1.08, with estimates ranging from 1.05 on the low end to 1.12 on the high end. That represents a near-term catalyst worth monitoring. Regional bank peers have historically traded in a range of 10 to 14 times earnings, so Truist is not obviously cheap relative to the group, though the forward compression is notable. Market sentiment around Truist Financial Corp, as of the creation of this video, leans neutral, with insufficient recent news flow to tip the balance in either direction. In our view, the valuation is neither deeply discounted nor egregiously stretched. It is a fair price story that requires an earnings catalyst to re-rate meaningfully higher. Moving to financial strength, How solid is the foundation? The Piotrowski F-score, a 9-point checklist that scores profitability, leverage, and operating efficiency signals, comes in at 6 out of 9 for Truist Financial Corp. That is a respectable reading, indicating the company is passing more financial health tests than it is failing, though it is not at the highest tier of balance sheet strength. The Altman Z-score, a model originally designed to assess bankruptcy risk, where scores below 1.8 traditionally signal distress, reads 0 for Truist. Here, context is essential. This score is effectively not applicable in its standard form to bank holding companies, because their balance sheet structure, with deposits as liabilities and loans as assets, renders the Z-score's traditional thresholds meaningless. Investors should not read this as a distress flag for Truist specifically. It is a structural limitation of the model applied to banks. On leverage, the debt-to-equity ratio is 0.99, meaning debt and equity are roughly balanced on the capital structure, which is moderate but not alarming for a regulated bank. The cash-to-debt ratio of 0.57 tells us the company holds roughly 57 cents of cash for every dollar of debt, which provides a reasonable liquidity cushion. Interest coverage is not available in the conventional form due to the bank's business model. In our view, the balance sheet is structurally adequate for a bank of Truist's scale, though not a source of exceptional comfort. Next up, profitability. Is this business actually making money efficiently? For bank holding companies, traditional margin metrics like gross and operating margin are not reported in the same way as industrial or technology businesses. Those figures are not available here in a conventional form. What we can assess directly is the net profit margin and the free cash flow margin, and both tell an interesting story. The net margin for Truist Financial Corp stands at 26.12%, meaning that for every dollar of revenue the company generates, it retains roughly 26 cents as net income after all expenses, taxes, and provisions. For a regional bank navigating the post-merger integration costs and a higher rate environment, that is a respectable reading. The free cash flow margin, which measures how much of revenue converts into actual cash that management can deploy for dividends, buybacks, or reinvestment, comes in at 28.24%, which is notably strong and in fact slightly higher than the net margin, a sign of quality earnings. The return on equity, the amount of profit generated per dollar of shareholder capital, is 8.19%, which is below what we would characterize as a best-in-class regional bank, where returns on equity of 12 to 15% are achievable. The return on assets, at 0.98%, is near the 1% threshold that analysts typically use as a minimum benchmark for bank profitability. In our view, profitability is functional but not exceptional. The margins are respectable, but the returns on capital tell us the franchise is still working to fully optimize the merged balance sheet. Return on invested capital is not available in a meaningful form for this business type. On to growth. Is this business expanding, and at what rate? This is where the data for Truist Financial Corp becomes genuinely challenging to defend. Revenue growth over the trailing 3 years comes in at a thin 0.6%, essentially flat, generating no meaningful top-line expansion over that window. Looking further back over the trailing 5 years, revenue growth is actually negative 5.2%, meaning the business has, on a net basis, contracted from a revenue standpoint over that period. Now, context matters here. Truist was formed from the BB&T and Son Trust merger, and large bank combinations often involve deliberate divestitures, balance sheet restructuring, and transitional revenue disruption during integration. The sale of Truist Insurance Holdings, for instance, was a significant strategic event that affected the revenue base. That said, even with that context factored in, the data suggests that the company has not yet demonstrated an ability to grow its top line with conviction, and the StockTok growth score of 0 out of 20 reflects that reality directly. On the positive side, book value per share, the net asset value of the firm on a per-share basis, has grown at 5.6% over the trailing 3 years, which suggests the underlying franchise is compounding value at a moderate pace, even if the income statement is not reflecting it yet. The dividend yield of 4.11% is a meaningful component of total return for investors willing to be patient, and the dividend adds income support while the growth story develops. In our view, the growth profile is the most significant risk in the Truist thesis, and we would want to see evidence of sustained revenue reacceleration before becoming constructive on this dimension. Now let's talk smart money. What institutional capital is actually doing with this name? 16 top-tier guru investors currently hold Truist Financial Corp across their disclosed portfolios. That is a meaningful level of institutional awareness for a large-cap regional bank, indicating the name is on the radar of serious, long-term capital allocators. Among the notable holders, Tweedy Brown, one of the most respected value-oriented firms in the industry, with a heritage going back to Benjamin Graham, holds Truist at 2.23% of their portfolio, though they have been reducing that position by 2.36%, which is a signal worth noting from a firm that tends to move deliberately. Christopher Davis of Davis Advisors, another well-regarded fundamental investor known for long-duration conviction in financial names, holds a smaller position, but has been adding, up 22.77%, suggesting he sees a longer-term value case building. Bill Nigren of Oakmark Funds, a highly respected contrarian value manager, is also disclosed as a holder with no recent change in position size. Turning to the broader institutional picture, only 9.2% of 13F filers, institutional investors required to disclose their holdings, are net buyers of Truist at the time of recording. A reading above 50% would indicate broad institutional accumulation. 9.2% suggests the institutional community is largely sitting on the sidelines or distributing. Insider ownership stands at just 0.59%, which is low. Management and directors own very little of the company relative to its market capitalization. More pointedly, in the last 3 months, insiders have recorded 0 purchases and 2 sales. Insider selling alone is not always a red flag, but the combination of near zero ownership and no buying activity is a data point that, in our view, warrants attention. The smart money picture is mixed. A handful of respected long-term value investors are engaged, but broad institutional momentum and insider conviction are both absent. And finally, the verdict. Let's bring it all together. On valuation, Truist Financial Corp is trading at a modest premium to its intrinsic value estimate, with a forward earnings multiple that looks reasonable but not compelling. The setup is fair-priced, not deeply discounted. On financial strength, the balance sheet is structurally adequate for a bank of this size, with a respectable Piotrowski score, manageable leverage, and reasonable cash coverage. Not a fortress, but not fragile. On profitability, the net and free cash flow margins are respectable, but returns on equity and assets remain below the levels we associate with best-in-class regional banking franchises, suggesting the merger integration has not yet fully unlocked the earnings power of the combined entity. On growth, this is the clearest weak point in the thesis. Flat to negative revenue growth over the trailing 3 and 5 years, with no evidence yet of a sustained top-line inflection, earns the lowest score in our framework and remains the key risk to the long-term investment case. On smart money, a small cohort of respected value investors holds the name, but institutional breadth is narrow and insider buying is absent, not the configuration we associate with imminent re-rating. In our view, the data suggests Truist Financial Corp is a show-me story. The franchise has scale, the dividend provides income support, and a successful earnings inflection could narrow the gap to analyst targets. But the burden of proof on growth and profitability improvement remains squarely on management. This warrants caution, in our opinion, until the fundamental trajectory improves. Everything in this video is our interpretation of publicly available data, not financial advice. Please consult a licensed financial advisor before making any investment decisions. That's the deep dive on Truist Financial Corp. Like and subscribe so we can keep providing you with no-nonsense, data-driven analysis of stocks. We will keep updating our videos as soon as new data that affects the stock becomes available.